We
All
go.
right, Bryce. I feel like I've followed you for a while. I'm sure a lot of people that are listening to this or reading this have probably done the same. But I think the thing that really stuck out to me is this idea that I've been grappling with in my head is growing revenue per employee. And I think one thing that you put out a few years ago is this idea that 100 million in revenue with under 10 employees is the modern generation of founders 4 minute mile. I kind of just want to kick off with that idea of like maybe what led to that line of thinking for you, like maybe some companies that you think are like progressing towards that goal today. And I'm sure I'll have some follow-up questions there.
Yeah, I don't know specific. I don't have a ton of specific companies in mind, although every week there's kind of a new list of companies that are emerging with tens of millions in revenue, maybe even hundreds of millions in revenue, with double-digit employees, which I think is really impressive. I think part of the thinking when I wrote that, which is now probably, geez, it's probably been up there for a couple years now, but really the thought was like there's this kind of I see what's happening now as this kind of response to a lot of what happened during ZERP, where you have this kind of cultural movement of entrepreneurs trying to take more control over their own companies. I think a lot of them felt that they kind of got into this kind of factory model of building a business of, you know, kind of jumping from round to round and really thinking about the business they were building in terms of the milestones they needed to meet for the next round of funding versus, kind of building something big and durable that could stand on its own 2 feet. And so, part of where that came from was I think we've got, what I would argue is the largest wave of second and third time founders and early employees of those venture-backed companies coming back to market, having now lived the venture experience. And that's not to say the venture experience is a negative thing at all, but it is to say like now they have information they didn't have before when they were starting those businesses. So they know now what it feels like to not be in control of your own destiny. They know now what it feels like to be led on by investors and told, no, come back with this number, and then we'll absolutely do it. And to come back with that number and to hear the kind of goalposts move again. So I think there's that like cultural piece of it. I think, what kind of unlocked that idea of the 4 minute mile thing was really that there's now this kind of massive lever in technology in terms of what this new wave of AI tooling is building. And you pair that with that lived experience. And I just think like the best, the smartest, the most ambitious entrepreneurs, like they want to keep their team small. They recognize that, kind of growth at all costs them more than they could have ever imagined. And so they're trying to kind of control this experience a lot more. They want to build with people they really care about, that they respect, that they trust. And that's often in response to like, you hear and a lot of people have lived, hiring for pedigree, hiring to kind of build the narrative for that next round and not necessarily building, hiring for the most efficient and effective additions to the team that they could make. And so, I think, what we're seeing now, I feel like is a real response to all of those kind of touch points that entrepreneurs have now lived through. And the ability to kind of get so much more done with so much less. And whether that is, you know, the, the founder that's now able to kind of take on 5 different jobs at once because they can now have like all of these effectively free assistants out there doing all this stuff, to coders being able to get so much more leverage and not manage a team of younger kind of up and coming coders. Like I just think you're starting to see so much more concentration at the areas, and levels of expertise that are really able to differentiate. And so whether you're ultimately able to automate all of that, or whether I believe there'll always be like a 10 to 20% gap at the top. And the people who can really own that 10 to 20% are going to create most of the value. And I think that's, to me as an investor, like, wow, how exciting is that? And I think, that's something we try to invest in and lean into with Indie, and that's also something, we are trying through the content we create to kind of share those stories so that people can kind of see what's possible.
I totally agree. Do you think, I mean, I've thought about the same concept a little bit of like what all has to happen in order to actually have $100 million in revenue with sub 10 employees. And I think at a really high level, you have to consolidate each of the different departments within an organization. I think it's more feasible, at least it seems like today, it's more feasible to do that with a lot of these back office functions where there is so much repetitive work. And I think it's a little bit harder to do that with some of the more like front office facing, like marketing sales. I think nobody wants more like AI generated content or like AI sales assistant, maybe like sales assistants, but like AI generated sales is just a lot more difficult to automate. Um, I'm curious if you have thoughts on the subject or anything that you're seeing that might be bucking that trend.
Totally. And I would say, a big part of that statement we made was as a provocation. Like we're not prescriptive, like, oh, you 11 employees, like you don't qualify
Yeah.
or, 20. But I mean, you look at something like, I don't know, Midjourney is a great example, right? Like Midjourney, I met an early employee at Midjourney a while ago, and they were probably doing north of 100 million with 20-ish employees. Like that, it just kind of blew my mind and to hear kind of what was going on. And a big part of that is not only the tooling, but it's also just how quickly these tools can get adopted and this kind of shortening this time to revenue. Like in the past, a Midjourney as a Web 2.0 company wouldn't have charged up front. It would have been this like free consumer thing and then they'd sell ads against it. But, I think this kind of shortening the time to revenue and really kind of getting feedback from paid users, I actually think is like wildly under discussed. I think there's so much value in that. And when you talk to the Midjourney team, when you talk to a lot of these teams, even the ones like Linear that aren't necessarily growing at that same velocity, but they've definitely embraced a lot of these same principles. Like that value, the value of that feedback from paid customers is just so valuable at that level. I think from, your question of, kind of how the work gets distributed. I do think I do think that's still an open question, and I think that's kind of emerging by the day. I think, part of what we do at Indie is we invest not only in the companies that are using these tools, but also the ones that are building it to kind of open up and enable these kinds of companies to emerge. But what I do think is really important is, and I touched on it in the previous answer, I do think there's this kind of 10 to 20% wiggle room of humanity that still exists. And in that, I think is all the difference. I think, I do believe that, how you instrument is important, but also what you bring uniquely to that sales process or to that, development environment or to that, kind of taste and perspective of what it is you're building or your relationship to that market. I do think that becomes infinitely more valuable even than, what we've seen in the past because so much of the other stuff is going to be, kind of table stakes that can be automated.
Yeah, I feel the same way. And I mean, I feel like you can also draw patterns with, I mean, what like the Slow Ventures Creator Fund. I don't know if you saw that news where
Yeah. Yeah.
they like propped up a fund where they're essentially just like investing in creators' holdcos because they see the value. I mean, if all of the back end is totally automated away and like all it really just at a high level stems down to winning attention and converting attention into customers, like these creators or people with massive audiences and build trust have a huge advantage. And so I think there's also more companies that are being propped up where like the creator, instead of just getting some form of advertisement dollars, they're negotiating larger equity stakes. And it's just like more of an emphasis on distribution via like partnering with people like that. And so I think kind of to your point, like that's where I'm seeing the world going.
Yeah, I think that's right. I mean, I think the interesting thing to watch on the creator stuff is like I'm dubious that creators have good taste in where to put their energy. like I don't know they have like great discernment of how to use that brand equity and that distribution in the highest value ways, right? Like chocolate bars are great, but what a weird, like burgers
Yeah.
are great. Like, but everybody's got a tequila brand, everybody's got a vodka brand, everybody like that
Yeah.
just, kind of finding the ways and audiences that can benefit from a lot of these kind of more uncapped upside types of opportunities, I think will be, it feels like a real challenge. And maybe that's something that Slow can kind of marry their experience on the venture side of the house with these kind of creators and helping them kind of figure out how to best leverage the audience they built and the attention
Yeah.
going forward.
I think it's really hard to find creators that are actually building valuable evergreen content too. I mean, I think my best example of a good creator is you probably heard of Mark Sisson from
Yeah,
Prime Kitchen. I mean, that guy he built his audience up via blogging for 20 years, where he was just kind of in these very niche health circles of the internet and he was sharing what he was learning. And I mean, you look at him today, like he is a walking testament to his content working. I mean, he's pushing 70, he might be older than 70, shredded. And he
right.
leveraged that audience to build Primal Kitchen, which was a healthier alternative to all of these condiments. It's like ketchup, mustard, mayonnaise without all these mysterious ingredients that are slowly killing us.
Right.
And it's $1 billion business now. Like he took the very long path to capitalizing on all of the trust and attention that he had built up. Um, so I think that's probably the best example I've got of a good creator and somebody that's like harnessing the audience and like pushing or putting all of his energy into something that actually compounds. Um, I feel like there's just so many creators today that I mean, just doesn't seem like like they're just on the content treadmill where they got to keep putting out like low quality content, low quality information, and like then they're selling to low quality consumers. I don't
Yeah,
know.
that feels like the real opportunity for the creator fund, right? Is to like allow them to step off the treadmill a bit, get a little bit more strategic in what it is they're trying to do and build. Hopefully have some informed advisors around them. What I've found generally with creators is they attract a lower vibration community around them when it comes to business stuff. And so hopefully they can kind of bring up that sophistication level.
Yeah,
Because, I'm with you. Like, I think, especially in this day and age and going forward, distribution is going to be such a valuable asset. It'd be a shame to see it going to, things that can't necessarily capture even a fraction of the value that the content, is creating.
yeah, 100%. I mean, kind of on the same train of thought, but I mean, as we move to this model where, I mean, if what all we're saying is true, where you can just build larger businesses with fewer inputs, fewer capital required. I mean, I've seen other people throw out this term of seed strapping, where it's just one and done. I think you were really early on that. I was reading something this morning
Would
where,
never call it seed strapping, but yes,
yeah, it was different
yeah,
branding.
yeah. What did I say? I think I wrote a post like, yeah, it's probably 7 or 8 years ago called like one and done.
Yeah.
Yeah. I mean,
Yeah.
I don't know where we land in terms of the word. I hope it's not seed strapping, but
I
who
think
knows?
it was like it was something, it was slightly different branding. But it's the same idea where there's just
Same
like more
idea. Yeah.
reliance on revenue, sustainable businesses over outside capital. Um, and yeah, I'm just,
Definitely the idea that like the world that we stepped into with indie, which is going on, geez, 10 years ago now, was very binary, right? The idea was you're either bootstrapping, you have no resources, and you're kind of antagonistic toward the venture world, or you raise a bunch of money and you get on this treadmill and you follow this kind of blitzscaling playbook. Indies response to all of that was like, wait, there's this whole world that sits in between those two. Why wouldn't you try to create a situation where you can get the best of both? And so, that idea of one and done, like, why not get some partners on board early to help kind of shape the business, to take some of the risk off the table, to allow you to pay yourself, um, to open up doors and bring, the best things the venture can bring to it. And yet at the same time, not put you on this kind of treadmill that so many kind of end up falling onto, which is, um, you kind of you get a little taste and then, then you get hooked on this kind of gateway drug. And then you never end up actually building the durable business. You get caught up in the game of it all, or the game within the game of kind of venture and how this all works. And so, part of what we're trying to do with the content is to find those founders who follow that path and show, just show that, look, these can be totally aspirational types of businesses to build. These are going to be founders that look and talk just like you. But I think a lot of founders don't even know that that's an option. So we're trying to create that kind of secret third option for founders to say, like, if one of those two binaries in that in building a business doesn't resonate with you, like there's a whole kind of world of gray that sits between those two that you can navigate and try to be the partner for them. Because I just think, like I said, you've got this, I mean, more people have been exposed to venture either directly having raised it or been a part of startup companies and venture-backed startups over the last 10 years. Like it's just this massive wave of people who are now informed in a way they hadn't been before. And I think can't help but think they're going to look for different ways.
Yeah, I totally agree. I mean, I think it's kind of ironic too, because you look at how a lot of these private equity like buyout funds work is they essentially try, I mean, they go into these, a lot of them venture-backed businesses, they strip out all the inefficiencies to make them more efficient. Like there's a path to get to that efficiency level without completely ruining everybody that's a common shareholder or anybody, like even like preferred shareholders holders that are prior investors. Like there's a path to that level of efficiency without going through the pain of like restructuring later. But I think
I
now,
think I think I think to me that was kind of when I read the founder mode essay, to me it was kind of like that acknowledgement of, wait, there's other ways to do this. Like, I don't necessarily, there's no one way to do this. I don't have to follow this very set playbook that's laid out for me. I have instincts. I have things that I believe. I see ways to build this business that are more efficient than the way that I'm being encouraged to do it. Why don't I control that destiny a bit more? And I think to me, you know, it wasn't necessarily like this kind of hammer meeting nail of the founder mode essay of saying like, oh, I'm gonna like screw everybody and I'm gonna be this dictator. I think a lot of it was just to say building a business and creating, kind of your own reality within the world or kind of bending the world to your reality. Um, it's such a personal and impactful thing to do. Like it's the most refining thing that I've watched people go through and gone through myself is like what an incredible way to bring who you are to the world. And yet immediately when you raise money, you're suddenly told like, oh, you can't do that, you can't do that, you need to do it this way, you need to say it this way. And so I think part of the response to that is like, man, let's really kind of create space for people to be their most authentic selves, to bring what it is they have, to these problems and to these opportunities. And that to me is how I read Founder Mode is like, you're giving up so much of yourself to fit into this weird game that you don't even understand like what the rules are. So you might as well just be your most you that you can be and let the outcomes fall where they may.
yeah, I feel the same way. I mean, I think it's also interesting to think through some cascading effects of that model. I mean, if venture funds and like seed funds start applying the same logic where like the goal is now to find these people, like there's really more emphasis on finding them and like becoming that part of that first check-in. But then finding quality businesses, like the entire venture math changes where you're not completely reliant on these outlier outcomes, which in and of itself, you could argue a lot of these outlier outcomes are dependent on bubbles. Like you can just hold a portfolio of cash flowing businesses where you still own meaningful equity. You're not worried about dilution and you don't have to factor that in. And you can just, and you're also not, I mean, maybe depending on your LP base, you're like, I mean, there's still some like risk around timing of like when you'll see returns from it. But I think the way that the world is going now, there's like more and more ways to get liquid, where I think secondaries are gonna become a larger part of GPs
Totally.
finding liquidity. So I don't know. I'm just like,
And the market is orienting to that, right? Like you're
yeah,
watching these mega funds kind of grow up into massive financial organizations. They have the early stage and tech DNA, and yet, you look at Ramp just did a tender offer. Stripe is doing tender offers. Databricks just did their tender offers. Like these are effectively operating as public companies without the scrutiny and creating that type of liquidity for early investors and employees too. And so I do think the game is changing dramatically in terms of kind of what success ultimately looks like and the paths to liquidity that kind of breed that success.
I think Sedona, you're familiar with Sedona.
Yeah, very.
And they have their secondaries fund now that I think they co-invest with Klein Hill. I'm not sure how it's structured, but it's a means to provide liquidity and DPI, which is the number one metric for GPs now. It's like showing distributions back. Um, so yeah, I feel like you can just kind of like at least get patterns to figure out where the world is going. And I don't know, we'll see
Totally.
it.
I mean, I do think there's so many interesting dynamics that are taking shape. Like the other day, Rob Go from NextView had this great thread on Twitter about risk and how, kind of raising money historically felt like a de-risking move. But now, just given how large funds are getting and how large these rounds are getting, it actually, you could make the case that a lot of the rounds that are happening are actually increasing risk and likelihood of failure versus minimizing it. And I think I actually think that's an incredibly important part because I do think so, the way that venture math is shaping up right now, success is nearly unattainable for everyone, right? Like $33 billion for the Wiz acquisition, and Insight doesn't even return a third of its fund on that. And so,
Yeah.
you can argue that Insight's a growth fund, and there's a lot of other dimensions to that, but like that was still a Series A investment that they made. And so not only um, do the outcomes just have to be so big in that new world? And that is literally the biggest private software acquisition of all time. And it doesn't even return a third of its Series A funds investor, like Series A investors fund. And so, I think that's a really interesting dimension to this kind of cultural shift too, this kind of informed company building that we're seeing now is, entrepreneurs recognize that some of these additional risks maybe aren't worth taking. Maybe it actually does not only um, minimize their likelihood of success, but it also caps, kind of what the ultimate outcome needs to look like for them. And so part of the one and done, the move to these kind of one and done seed strapping types of moves are that it does create and preserve so much optionality for founders. Like you said, now you've got a situation where you can be taking secondary, you can be selling the business. And for early investors, if you aren't having to defend your pro rata every 12 to 18 months, you can actually own a meaningful part of these businesses and just let it compound over years, which is such a foreign concept in early stage venture, right? Like we have some indie companies that haven't raised for like 7, 8 years. And these are now doing tens, if not hundreds of millions in ARR. So for us, we look at that and say, holy cow, we've not had to put up another check. We've
Yep.
not had to take solution. And all of that value has just been able to compound. And along the way, there's always been opportunities for liquidity. There's always been opportunities to sell these businesses, but the entrepreneurs, they think there's still more value to create. And for us, like what a great journey to be on with them, where every year, every month, we just gonna get to keep compounding.
Yeah. Yeah, I think it's interesting to think about, and like I feel like it's a conversation I'm having with more and more GPs of just like if this all comes true, how does it change your own portfolio construction? I mean, I think it's a net positive both for GPs, founders, LPs. It's like who doesn't want more quality companies in the portfolio and like not having to waste and
And,
blow.
and better for customers too. I think it's always so interesting. The customer gets lost in all of this. I mean,
Yeah.
over the weekend, I saw some kind of fancy design tool getting shut down because they couldn't raise their next round of funding. And it's like I'm watching other companies offer to kind of take on their customers for them. I'm watching them kind of flog themselves for, leaving their customers high and dry. But like that's a very real thing. Um, you've got this window and this opportunity now where so many customers have been burned by like VC-backed companies hitting a wall and running out of cash and leaving them with like no product and having to offload. I think there's this kind of really unique opportunity to now be, profitable, durable, we're not going anywhere types of businesses that, people can really invest in and rely on. I think that may end up being this kind of new vector for competitive advantage too.